Good afternoon. My name is Enid Slack, and I'm the Director of the Institute on Municipal Finance and Governance here at the University of Toronto. On behalf of the board and staff at IMFG, I'm pleased to welcome you to today's talk, Building a Residential Property Tax from Scratch, the Irish Story, with our guest speaker, Gerard Turley. Today's event is hybrid. What does that mean? I guess we're all getting used to that term. Hybrid means there are a few of you here in the room with us today, but there are more people on Zoom. So welcome to everyone here and welcome to everybody on Zoom. Before we begin, I wish to acknowledge the land on which the University of Toronto operates. For thousands of years, it has been the traditional land of the Huron-Wendat, the Seneca, and most recently the Mississaugas of the Credit. Today, this meeting place is still the home to many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work on this land. I would like to thank IMFG's external funders, Havana Capital, Maytree, the Neptis Foundation, the City of Toronto, the Region of Halton, and the Region of York. I would also like to thank Piali at IMFG, who's sitting up here, and we'll hear from her a little bit more later, and Adam and Daria at the Monk School for their help in putting the event together today. If you are tweeting about this event, our hashtag is IMFG Talks, and our Twitter handle is @IMFG Toronto. Today, we're going to be talking about property taxes, a subject that you know we have written a lot about at IMFG over the years. I think one of our very first IMFG papers was on property taxes. And as you know, I myself have written a fair bit on property taxes over the years. But all Canadians know a lot about property taxes, in part because we pay them, and in part because property taxes bring in a significant amount of revenue for local governments. When we look around the world, Canada actually stands out along with the UK and the US in terms of the amount of property taxes collected relative to GDP. Whereas property taxes account for about 1%, just over 1% of GDP on average in OECD countries, they account for over 3% of GDP in Canada and close to 3% in the UK and the US. Not only does the property tax bring in a significant amount of revenue, it is also a very visible tax. And what do I mean by that? It's visible in the sense that people know what they pay in property taxes. They may pay them once a year, twice a year, every month, but it's a tax that they have to pay. It's different than the income tax. The income tax for people who are not self-employed is deducted at source. So when you get your income check, the income tax has already been taken off. So people don't tend to know what they pay in income taxes. And if they do, you ask them what was their federal income tax, what was their provincial income tax, they can't separate them. Also, the sales tax is something that we pay in small amounts on each purchase. So we know that we pay 13% when we buy things or we use services. But even a tax nerd like me doesn't know what I pay in sales taxes over the course of a year. But we do know what we pay in property taxes. And so both the size of those taxes and the visibility make it difficult to reform the tax or even to increase it on an annual basis, as we see at budget time every year. So imagine trying to introduce a property tax from scratch. How would you do it? What would you include in the tax base? How would you value the properties? How would you set the tax rate? And most importantly, how would you convince taxpayers that it's a good idea to bring in a property tax? Well, Gerard Turley is going to talk about just that, introducing a new residential property tax from scratch in Ireland. So the way we're going to proceed is I'm going to introduce Gerard. He will speak for about 40 to 45 minutes. After that, I will join him and he and I will engage in a brief discussion followed by a Q&A with the audience. We will take questions from here in the room, and you can see there's a microphone there, but we will also be taking questions from the online audience. For those of you who are online, please use the Q&A function at the bottom of your screen to send in questions, and you can do that starting now or anytime throughout the talk. We will try to get to as many as we can. So, Gerard Turley. Ger is an economist and lecturer in economics at the University of Galway in Ireland. Interestingly, he started out as a foreign exchange trader and economist before joining the academic world in 1990. He has lectured in Ireland, of course, but also in Central and Eastern Europe, Russia, China, and the US. Ger's research focuses on local government finance, territorial restructuring, local government reforms, fiscal equalization, financial performance, and the property tax. That sounds like my resume. And also Ger operates and co-manages a website on local authority finances, and it's www.localauthorityfinances.com. So we're delighted to have Ger here as a visiting fellow for 3 months. He's sort of halfway through, a little more than halfway through his visit here. And we're really happy to have him give this talk this afternoon. So over to you, Ger.
Thanks. Okay, I'm very glad to have to take this off. So thanks, Enid, for that introduction, and more importantly, thanks to Enid and her team for hosting me over the last, I think it's about 7 weeks now, and I have another 5 weeks to go. I really enjoyed it, so hopefully I'll continue to enjoy it while I'm here. Thanks to the donors, and thanks to people who have met over the last, I think, 5 or 6 weeks. Many of them are in the room here, and if not, some of them may be online. It's been great to talk to them about property tax in Ontario. I suppose in particular, I want to thank 2 people. Anmar Shashoni, who's sitting down there, for all his insights into taxation and the anecdotes. And also Andrew Wang, who's also sitting over there, in that we've shared an office for the last 5 or 6 weeks, and that's made life enjoyable, walks and talks. And he also suggested that I use the blue as a background. It's the U of T colours, I believe. It's going to change later on. I'm going to use the green of Ireland, but for now, I think I'm going to stick with the blue. Where to begin on property tax? I thought this might be a good place to start. A cartoon, one of my favorite cartoons, not just because I'm a dog lover, but also because I often think, when running through this talk, I'll talk about disconnects between the economics and politics of property tax, disconnect between theory and practice. And this is a very good example of disconnect between, on the one hand, voters and taxpayers and politicians who don't particularly like the property tax for reasons that I think Enid alluded to, whereas possibly everybody in this room, or most people in this room and some people online, like the property tax. As academics, as technocrats, as advisors to government, as assessors, as tax lawyers, many of us get our income, our livelihood from property tax, or we think theoretically it is a good tax. And therefore, I think we should always keep in mind what voters and taxpayers think of it, because of the visibility, the salience of it. So a picture is worth 1,000 words in this case. So hopefully the structure makes sense. When I was talking to Greg Martino the last day, we were talking about the property tax. At the end, he was very kind to say that he thought it was a fascinating story. I don't know if you'll find this fascinating. I think it is. At the least, I think you'll find it interesting, particularly when you look at some of the aspects, the unusual aspects to the Irish residential property tax. So to begin, I was trying to think for the Canadian audience to get an image of Ireland. So trying to put this into your head, which is, because you're all well aware of what's on the right-hand side, but maybe less so on the left-hand side. If you can imagine taking the population, someplace between the population of Metro Toronto and Metro Montreal, so about 5 million, and take them, if you dare. Now, we're not as cosmopolitan as maybe Torontonians, and we're certainly not as French-speaking as people from Montreal. But take them and put them into New Brunswick, which I think is about the same size as Ireland. Scar them a bit, but keep a lot of them on the east side. Do not devolve powers by any means to the regions or the municipalities, so very centralized. Move it across the Atlantic, as you would, until you get to Europe. And a little bit that's detached from Europe, but is still part of Europe, what's called Great Britain. Stop there. Add a bit at the top, a kind of contrarian bit. You have it in Canada, it's called Quebec. We have it in Ireland, on the island of Ireland, it's called Northern Ireland. Inflate the national income figure. So anybody who's good at maths, if you're working out what the income per capita is for Canada versus Ireland, you would have thought they would be about the same. And they are about the same, but that's not the case if you look at the GDP figure in both cases here and divide it by the respective populations. But anybody who knows anything about the Irish economy will know, because of multinationals, their presence and their activities, these are largely US multinationals, the Irish figure is very inflated. So you really need to take a percentage of that. Aside from that, if you inflate the national income figure and inflate property prices, you've got Ireland. So keep that in mind as we go through this. Now, in terms of a background to this, I've already mentioned our neighbours, England, and like so many things in Ireland, they come from England, and certainly property tax is true in that case. So the English system is called a rating system. It was, and it's still at least one of the two halves. So the Irish system is a rates, what we call commercial rates, and we take that from the English system, which goes back. You can date it back to 1601, the Poor Relief Act, and you can probably date it back much longer. So the Doomsday Book in William McConker, and in the Irish case, probably as far back as the 12th century, Anglo-Norman times. And we all know that that's true because we know that property tax is a very old tax, land tax, one of the oldest taxes there is. So we had a single integrated system, as the UK did up to about 30 to 40 years ago. And one half of that is still in existence. What's called the business rates in Britain, and what we call commercial rates, the non-residential side of property, and it's based on annual rental values, what's called the net annual value. On the residential side, what we used to call domestic rates, so residential property tax was abolished in 1978. Now you might ask, why to abolish it in the first place and why 1978? And the second half of that is easier to answer, which is we had a general election in 1977. And parties promised. Now you don't expect parties to promise and necessarily deliver on their promises, but in this case they did deliver on their promises and abolished it. Why was it abolished? Well, as Enid said and alluded to earlier on, it's not very popular. And in the Irish case, because the valuation system was out of date, so valuations, no general valuation took place between the 1850s and 1977. There were valuations in parts of the country. There were valuations in England for a good number of years, but that also stopped. So there was a feeling that a lot of this tax burden, there was inequities across different properties, across neighborhoods, and because health had been devolved at the time, bills were going up. So for those reasons, for those political reasons, the decision was made to abolish property taxes, residential property taxes, and not to replace it with anything, in that there was a general grant to replace it in terms of the funding of local government, but no replacement of any sort, which is unusual in the sense of Normally, as in Ontario in 1998, I think it was, you moved from one system to another. That happened in Northern Ireland, it happened in the UK, it didn't happen in the Irish case. There were attempts to reintroduce it over a longer period of time, but the attempts didn't succeed. There was an attempt in 1983, but that was not assigned to local government. And it worked off two thresholds: a property tax. If your value was only above, did you pay? And only if your income was over above, did you pay? And then in more recent times, we had two flat rate taxes, poll taxes, that were introduced. Didn't last too long. Until in 2012, 2013, we had our new, what we call local property tax. So the other bit of background that's important is local government finance in Ireland, the structure of local government finance in Ireland. And again, okay, Ireland is a small country, therefore you might be surprised that there isn't too many local authorities. And yet, if you look at some small countries in Central and Eastern Europe, and Shoshone knows this very well, it's not uncommon to have a small country with many, many, many municipalities. That's not the case in Ireland. We've got 31, so it's a nice small number to work with. Doesn't provide you much data, but unfortunately, that's the way it is. Just to be a bit more, we had 114 local government units until 2014. During the years of austerity, there was a move to reduce costs, and one of the things we did was we merged a number of neighbouring councils and we abolished town governments, as we used to call them, municipalities. So all we have are 31 local councils, as we call them, 3 city councils, 2 city and county councils, and 26 county councils. And they're very big by international standards. I think the only country, I think, in Europe that would have bigger local government units as measured by population is, in fact, our neighbour, Great Britain. So it's a highly centralised government, a country in terms of governance. And you might ask, well, why? And generally the answer is history, and that's true here, in that our system came from England, and England was centralised. Now it's not centralised as much now because they have devolved powers to Northern Ireland and to Scotland and to Wales and to cities in terms of mayors. That was one reason. And of course, the other reason is that our government, our nationalist government that came into power in 1921-22, for a good number of years had a general distrust of local government. Saw them as inefficient, saw them as corrupt, and therefore everything was centred, and in particular in Dublin. So if you look at the functions, very limited functions assigned to local councils, not only limited, but actually diminishing, in the sense that local governments were responsible for water and wastewater. That's no longer the case. That's been reassigned to a national utility company. And they were also responsible for waste collection and disposal. That was outsourced and then eventually privatized. So in terms of what local governments have responsibility for, it's really classic local services and housing. And so a lot of them are, if you think about it, property related, and therefore it probably makes sense to pay for that through a property tax, a local property tax, in conjunction with the other 2 mains of funding local government, which is charges and fees for local services and central government grants or transfers. So the only local tax we have is a property tax. So this is from 2021. It's a budget figure. It's during COVID. You can see on the left-hand side is what we spend it on. And if this was the capital budget, it would look almost the same thing, which is a large percentage of it goes in the form of housing, social housing supports, homelessness, traveller accommodation, and then roads. And that's not roads in transit, it's actually just roads, local and regional roads. And then if you look at the right-hand side, how it's paid for, there's your normal sources of funding. If you add up the 2 property taxes, it comes to probably 35, 36%. That's probably not uncommon. Before COVID, that would have been a little higher. It would have been about 40%. But since COVID, local governments have got a lot of support from central government. So it's slightly changed in the last 3 or 4 years, but you can see how the structure looks. Okay, so the background to this and the rationale, and this is where it gets, I guess, hopefully more interesting in a way, which is Ireland was an outlier. And that is, I would struggle to think of, maybe Enid knows, it developed, certainly in the OECD, the EU and the OECD countries. I mean, I don't know, I think Malta may not have, Monaco may not have, but most countries, high-income countries, and not only high-income countries, most low-income countries and middle-income countries have some form of a property tax, which funds local government. And yet here was this outlier in the northwest of Europe, which had no property tax on residential properties. Now, there were taxes, of course, on properties assigned to central government, which were largely transactions related. So stamp duty, capital gains tax, capital acquisition tax. But as I said, all assigned to central government and not local government. And then we had the Celtic Tiger. I don't know if you heard of it, but that lasted from about the 1990s all the way through to 2007. Until we had the financial crisis. And even if the international financial crisis had not happened, we would have had a crisis ourselves because of the enormous increase in property prices that had taken place, supported by domestic and international banks. So basically, we had a very, very big boom, and unfortunately, a very, very, very big bust. From about 2008 onwards. So described, now I've seen terms like unparalleled in modern economic history, but think of this as one of the biggest banking crises and property crashes in modern times in a developed country. And you get some sense of what it was like between 2008 and about 2012, 2013. So much so that we ended up with a bailout, an international bailout, the IMF, that's the EU, but I suppose technically it's the European Commission and the European Central Bank. And what followed that was a period of austerity, not unique to Ireland, but a long period of austerity. So at the level of the sovereign was short of revenue. There was a big fall off in revenue and it was a very narrow tax base. So governments, the central government and international financial organizations, and that's the OECD and the IMF in particular, were advising government, or the Irish government was looking at new ways of raising revenue or kind of low-hanging fruit. And probably the two lowest low-hanging fruits to go after were the fact that we were not charging for water to households. There was no domestic water charges, which seemed again a bit of an anomaly, a bit of an oversight. And second of all was the fact that we weren't charging for property taxes on the residential side. And it's a really interesting story there in terms of what's happened with water charges and what's happened in relation to residential property tax, because we've been able to introduce one, but not the other. And question is, well, why can you introduce one and not the other? So in terms of obstacles, now, please remember that this is not a kind of a developing country. This is not a transition country. This is not a low-income country. So we had certain advantages. The advantages were that there weren't high levels of corruption. There weren't high levels of an informal economy. There wasn't any issue over property rights or ownership. There wasn't an issue over a functioning property market. There was a functioning property market. It may not be well functioning, but there was one. In terms of the housing tenure, it was fairly homogeneous. So there were many reasons for why this could be done. But the problem is that there were three problems: one political, one economic, and one, I would say, administrative and technical. So I suppose the big one is political, which is, and it was a Labour government, it was a coalition government that was trying to introduce this. But at the time, there were parties, particularly on the left, hard left, that opposed, oddly enough and ironically enough, a property tax, which many people would consider to be a tax on on capital, a wealth tax, and yet for populist reasons, they certainly opposed it and still oppose it, and I'll come back to that later. They viewed it as a kind of an unfair tax, as a house tax, a home tax. It was described as double taxation, because anybody who bought a property during the peak were paying a very large amount of stamp duty, and now we're paying again. And as a property owner, you don't distinguish between one tax going to the local government and one tax going to the central government. It's all tax, and it all has to come out of disposable income. So there was big political obstacles, and of course the economic obstacle was that these were really difficult times, and it's hard to portray now what it was like back in Ireland in 2008, 2013. So output had fallen in 2008, 2009, and then when it recovered, it was really flat for a good number of years. And the same is true for wages, high levels of debt, and high and rising unemployment. Now, I don't know when you introduce a property tax, there's an argument, well, here's a crisis, let's not waste it in crisis, or things are good, lots of jobs, this is the time to kind of reform. But that was the economic environment within which the authorities faced. And then in terms of the technical and administrative difficulty, there would have been a cadastre way back for the old system before 1978, but that was based on net rental values. And that was 35 years old at that stage. So many properties have been built between that period of time. So there was no up-to-date, comprehensive database of residential properties that the revenue could rely on, that you would expect to have. We didn't even have a postcode in 2013. Never mind a up-to-date database of properties. So that was kind of the background that revenue and the authorities faced. Now, I kind of alluded to this earlier, which is the idea of a clean slate or a blank canvas, which is, on the one hand, you might think, well, isn't this a great opportunity? Because you can take from what's worked in other countries. There's always a danger transposing things from one country to another. It doesn't always work. In fact, it may not work depending on cultural and institutional differences. And it's unusual to have this opportunity. I mean, I've talked about other examples here in Ontario and in England where they changed from one system to another and did it either immediately or phased in over a number of years. Whereas in the Irish case, what happened was we abolished it and didn't replace it until 35 years later when we did try to replace it. So in terms of what this might look like, and anybody that's worked on property tax knows that these are your kind of standard features or characteristics of property tax, whether it's residential or non-residential. So it's the tax base, liability, rate, assessment, / valuation in some cases, collection, payment, enforcement. Now, I don't know if the designers, sat down and had a table like this and said, listen, okay, we're going to choose buildings only, and we're going to choose area-based. Policy making is not that easy. It gets very, very messy. So I'm not quite sure if all these options are really on the table. I suspect they weren't. So if you look at this, if you take land only, and I'm sure this comes up because it always comes up when I present this, the Irish residential property tax, it was initially envisaged to be a land or site only tax. But I think looking back now, I think that was probably not going to be a runner for all the difficulties involved in a land or site value tax. Area-based versus land-based. Area-based is very popular, for example, in Eastern Europe and Central Europe, post-Soviet Union, post-socialist system. I'm not too sure that anybody ever consider an area-based system for Ireland as opposed to a value-based. So what do you do when you want to establish in this case, a new residential property tax, well, you set up a commission or a committee or a group. So over the last 40 or 50 years, you've had it. So you've had the Smith Committee, you've had Blair Commission, you've had the Fair Tax Commission, you've had the Goyet Report, lots of them. Believe me, we've had the same, different names, of course, but we've had all the same going back over a long period of time. So that's exactly what they did. They set up a working group comprising 5 central government departments, the kind of departments that you might expect: local government, finance, public expenditure and reform, 2 others, and revenue. So revenue was involved. So your revenue agency, our similar. Revenue was involved not just in the administration and collection, but was also involved in the design, very much involved in the design, which you mightn't expect because they are carrying out what's being agreed by the policymakers, chaired by a senior public servant. This was the terms of reference. Now, just to talk about the other characteristics or principles of taxation, it refers to equity, but it also later on referred to efficiency, simplicity, and transparency. And this was to address a number of long-standing issues with respect to public policy in Ireland. Okay, so it was called the Interdepartmental Group. It was looking at the design of a property tax. It was formed in 2012, and the report came out in July 2012. Now, there were a number of other reports prior to that. There was a tax strategy group in 2010, and there was a very long, probably about 600 pages, a commission on taxation, which looked at all areas of taxation, published in 2009. And in that commission on taxation, they had 2 chapters looking at property tax, one on property tax in general, and one on how do you fund local government. In all 3 reports, they more or less recommended the same features. They did not recommend a site value tax, as the government had promised, but went for a more market value land and buildings tax. And if you look at the features there's some that I'm going to refer to later because they are a little unusual, I guess, is to say it politely, or different to what you might expect. And in particularly, it's the self-assessment for property tax, which is unusual, and valuation bands, which again, I'm used to over anybody who's lived in England since the early 90s would be familiar with valuation bands with respect to the council tax. But this is in respect to Irish residential property tax. So the timelines, very tight. So this is 1 year between July 2012 and July 2013. And so everything had to be done. Report had to be published. There had to be legislation. There had to be a model developed, valuation model. There had to be a register compiled, a PR campaign, returns sent to the liable person, and payment due. And this all took place within 12 months with no delay that I'm familiar with. So this is what it looks like. This is the icon and the picture that is used in the Irish context. And as I've said before, it's kind of the features that are some of the features that you'd expect. And the kind of mantra that we use in relation to property tax is ideally, it should be a broad base, low tax, low rate system. And it is more or less a broad base, and it is more, well, it certainly is a low rate tax. But you've got to add 2 other features to it, which is it's based on self-assessment, and we're using valuation bands. So if you look at the base itself, it's all residential properties or dwellings. So there are some properties that aren't included in the base, kind of the properties that you might expect, diplomatic premises, mobile homes, vessels, properties that are vacant and unsuitable for dwelling. There's a list of exemptions. It's not a very, It's not a very long list, and if you look at the income forgone, it's not actually a large amount. And if you look at deferrals, you can defer. It's based really on income, and again, the amount of income forgone is not very, very large. So, what was decided? If we go back to the previous slide, in bold, this is what was agreed for the new local property tax. Now, so I want to highlight, I suppose, two of the unusual features. One, which is self-assessment, and two, which is valuation bands. I suppose the question is, why self-assessment? And other than the fact that the previous reports had all recommended self-assessment, you might ask, well, why is that? Revenue had a long history and a good experience with self-assessment for income tax purposes. For example, the self-employed that spent and put a lot of resources into online taxpayer services, into filing returns online. But I mean, I doubt very much if revenue was sitting around and going through the proceedings of the National Tax Association from 1977, where you can find the paper on self-assessment for property tax purposes. Likewise, I doubt if they were aware that self-assessment is used for property tax purposes around the world, but in very few cases. We've talked about this before. Municipalities in Colombia have used it, in Bogota, and other municipalities. I think Richard Burr talks about it in Bangalore, in India, I think in some Central American countries. Now, it's different from one country to the next. They call it self-declaration, and the Irish system is different to all of those. But the Irish authorities did decide to introduce self-assessment. And this is what they say about self-assessment, not revenue itself, but to who worked for self-assessment. It was seen as being more appropriate given the constraints that applied, such as the tight time frame for implementation and the lack of an existing valuation database of residential properties. So once that was decided, then the job of revenue was to educate the taxpayer in terms of how to self-assess your property. And that was no mean feat to do because, okay, there are websites, 2 property websites that are available, but that's based on sales. And only since, I think, in some cases, not that long ago, there are professional auctioneers or real estate agents that you can use to value your property. There is a register of property sales since about 2010 that uses revenue stamp duty data. So what revenue had to do was provide guidance to the taxpayer as much as they could. So the guidance that was provided was a printed copy, ran to 184 pages. Now, you didn't read 184 pages. What you did was you looked at one line on that document. So basically it was based on where your property was, the local authority. You then had to look at the age of the property, whether it was before or after 2000, and then you looked at the property type. And when you chose your property, what revenue provided was an indicative valuation band for that area. Band 1, 2, 3, 4, 5, 6, all the way up to 19. And that was an indicative guidance provided by revenue. More likely, you were to use the online portal that revenue developed for this. Now it's changed. It's changed between 2013 and 2021 when we had our second revaluation. But it's more or less the same, which is this is an interactive map of the city I live in, Galway. And if you can zoom in, and you zoom into where your property is, and what revenue would provide is not an estimate of the value of your property, but an estimate of the indicative valuation band for properties in that area. And Revenue said you can use this in conjunction with, remember that if your property is in any way unusual, for example, if it was run down or if you had built an extension to your property, then you must take that into account when you're valuing your property and when you choose the valuation band. Because when you're returning your file, when you're filing your return, it's very straightforward. There's three things that you file with Revenue. One is not the value of your property. One is the band in which you believe your property lies in. And we'll talk about bands very, very shortly. Two is the charge associated with that band in euros. And three is the payment option that you have chosen. So if you look at valuation bands, and again, just looking at the time here, valuation bands are very familiar to anybody that has a property in England, Scotland, Wales, or in this case, Ireland. So valuation band is, as it appears there on the left-hand side, these are the original valuation bands. The advantage of a band is that it's easy in a sense to introduce in terms of the burden on the revenue and the burden on you as a taxpayer. Because property tax is presumptive and a lot of people are unhappy with the assessed value they get, they may be more happier and they may be more willing to accept a band of 50,000 as opposed to a precise value of 637,000. And it did help with the valuation challenge. The problem with bands are that it lacks accuracy. And it's quite arbitrary in terms of how many bands should there be. And what is the interval of a band? And of course, the problem is there may be a lot of clustering at the edge of these bands. And of course, it may lead to a certain amount of inequity, depending on how you design these valuation bands. The bands we have are different to the UK, and that's a kind of an issue in its own right. So how this works is that you choose your band from 1 to 19 or 20 in this case, and the rate was 0.18% of the midpoint. So you multiply 0.18% of the midpoint of your band, and that gives you your charge or your liability. And if you're looking at this, those amounts, by the way, are not monthly amounts. These are yearly amounts. So these are not what you might expect in relation to property tax, residential property tax. But please remember that this is to pay for a lot fewer services than you might expect because of the limited remit that local government has. So once the decision was made that this was going to be self-assessment, Revenue then had to rely on a number of different ways to try and ensure compliance and make non-compliance as little as possible. So what did they rely on? Well, the reputation of Revenue. And I think once it was decided that Revenue was going to be responsible for the administration of property tax, if I can use the term, it kind of put the fear of God into property owners, because in previous years, either the local authorities collected it or an agency associated with the local authorities collected it. But this is the first time that Revenue is given responsibility for the collection of local property tax. Revenue preferred going down the route of the carrot rather than the stick. So voluntary compliance. So minimize the burden as much as possible and facilitate compliance as much as possible. And the way that they did that, of course, was to put a lot of resources into this platform, give as much information as possible to homeowners, and then come up with kind of administrative mechanisms that would help with compliance. So you have this thing. So when I got my return in 2013 and again in 2021, there was a thing called a revenue estimate. Now, a revenue estimate is not the estimate that Revenue put on the value of your property, because they don't know what the value of your property is. It's my job to value my own property. What they came up with is a revenue estimate, which again is indicative, and it is only a kind of it's a liability, it's a default liability that is payable in the case of non-compliance. So revenue was saying, okay, well, here's an estimate. You don't have to return this. In many cases, it wasn't returned. It was either under or over valuations compared to the revenue estimate. But revenue was saying, okay, if for whatever reason you don't comply, there's no return, then we have an amount that we can go after. And I remember when the chairperson of revenue was asked this, about what do you mean you can go after this? She said, well, we'll just simply take what is due. And they can take what's due because of the powers that revenue has and because of the legislation they have, which is you have what's called a mandatory deduction at source. So deduction at source is a payment option. So Enid alluded to the fact that we don't like property tax because you pay it maybe once a year or 12 months in the year, but we know what it is. And it can often be quite large. It's visible, it's salient. So the way to kind of soften that pain is to get your employer, private or public, or your pension provider, or if you're on welfare, the Department of Social Welfare, or if you have a farm, the Department of Agriculture, to deduct it at source. But not only that, there's also what's called mandatory deduction at source, which is the revenue can instruct payment from you using the mandatory deduction at source powers that they have. Was it used? I mean, the figures that I've seen in the first 3 or 4 years, on average, about 50,000 of these powers were used. Now, remember, we're talking about 1.8, 1.9 million properties, about 1.2 owners of properties. So again, it was a way to kind of force compliance. You've got the normal debt collection mechanisms as well, which is you've got a sheriff that can normally inspect, challenge, seize goods or whatever it is. You can go to court. Now, I wouldn't suspect, and I wouldn't suggest for one moment that you would go to court for amounts that are liable. And in general, they haven't gone to court. I don't know, in fact, is there any single case where it's gone to court. Whereas in England, they've used both carrot and stick. And in England, in fact, not only have people ended up in court, but people have ended up in, I think, in prison for non-payment of council tax. And this is not the approach that revenue has taken. And then there are, of course, other sanctions, penalties, financial penalties, surcharges, interest. There is a holding back or withdrawal of the tax clearance cert. So if you're self-employed or if you're in the business of winning a government contract, you need these tax clearance certificates. And of course, if you don't pay, it remains a charge or a lien on your property. So these are the payment options. So revenue was very strong and trying to make this as easy as possible. So a whole rake of different payment options available. The ones you kind of expect, but then other ones that you may not think of in terms of property tax. And over the years, more people have opted for installment. They thought that maybe in 2013, this would be a once-off payment. Of course, it hasn't been a once-off payment. These roll over from one evaluation to another. So it's not like you have to, as a taxpayer, revisit this every year. And you can see over the years, there's an increase in terms of installments. There's an increase in preference for deduction at source. Okay, so in terms of, how am I doing in terms of time? Okay, so in terms of statistics, we can talk about these later on. I suppose what's particularly interesting is, given its self-assessment and given that it is valuation bands, the obvious question and the drawback, of course, with self-assessment is, are taxpayers going to be honest? Are they going to value their properties in an honest and reasonable way as revenue encouraged? So how do we know whether they have been or not? And this is a difficult one in terms of the data, because we don't know what the valuations of properties are. Revenue, I mean, I've asked revenue time and time again what's included in their database. And of course, because of self-assessment, there's not a huge amount included in their database. They have the name of the liable person, they have the property, they have, if it was sold, then they would have that from stamp duty data. They would have my return from 2013, what I thought it was valued at, in terms, and that's only the valuation band. And that's pretty much it, if even that. So if you look at the number of what you might call undervaluations. Now, an undervaluation, it's not really an undervaluation, it's the difference between the revenue estimate and what you returned. And about 80% of those are the same as what revenue guidance provided, or one band lower or higher. Now, revaluation always comes up, so I'm going to leave that for someone to ask a question on that, because it is an issue and it's a thorny issue. Also what comes up is, given the nature of where we took this from in the first place, this Ireland versus England, this is not a rugby thing, this is the Irish local property tax versus the UK council tax. I'm going to just turn to the last three things, which is the verdict, the challenges, and the lessons. So, the verdict. So my verdict on this is, given the obstacles and given the speed at which this was done, I think it's pretty commendable. We have a paper coming out, and that's kind of the word. I'm very careful in terms of what word to use. It's commendable that this was introduced in the first place and that we still have it. The literature talks about the difference between data valuation-led approaches and collection-led approaches. And if anything, this is certainly a collection-led rather than a valuation-led approach. Success, how do you measure success? Well, if this was, and it was, a revenue generation mobilization effort, well, then it has succeeded, because the aim was to introduce a residential property tax and bring in about 700 million Canadian dollars. Now, I don't know how big that sounds, but it's not very big, but that's pretty much what it's done. So on that basis, you could regard it as a success. And if you look at the other big public policy initiative at the time, which was to try to introduce water charges to households, that was a failure. Normal, what I mean by normal is that revenue would regard this now as a normal part of the business of revenue and a normal part of the business of property owners. And it certainly isn't perfect. There were mistakes made, a number of mistakes made, and valuation and assessment is a really big issue. If you take the time to look at that portal, there are issues over the valuation bands and properties within the area that have this indicative amount. So, in terms of the challenges, I put a question mark after all of these now, because I'm not too sure will we get to address any of these issues. And I kind of change my mind every week on whether or not there will be another revaluation as promised in the next 3 or 4 years. Will there be an increase in the rate because the rate is low? It's in fact lower now than when it was first introduced, but I'll deal with that when we talk about revaluation. And whether or not we introduce a vacant homes tax, which is promised for next year. And I know that it's here in Toronto and in Vancouver and British Columbia. Medium term, I guess the two big issues really are these, what the OECD call these interesting peculiarities about the Irish property tax. That's how they describe it. That's probably diplomatic, which is the valuation bands and self-assessment. Burden on non-residential, of course, that's an issue worldwide. I think the communication from revenue has been very good. I think the communication from the local authorities in terms of what LPT pays for has been less good. I'd like to see more information on that. So, in relation to the lessons, this is always maybe the difficult one. So, what has revenue learned from this? Because they're probably the closest to it, both the design and implementation. So in 2013, there was an ITD conference in Rock. I think I mentioned this to Enid. Richard Bird presented at it. So did our revenue, Joseph Fennelly. And this was the year in which it was being introduced. And from her slides, this is what she took away from the lessons that they had learned about the introduction of the residential property tax. And we can talk about some of these maybe later on if you're interested. In 2016, a chapter was written by the two people in revenue who worked closely on the valuation model that they developed. And they identified 3 lessons. Don't ignore the letter from the taxman or woman, keep it simple and easy to pay. Now, I would have added all these other mechanisms as well as important in terms of going forward for other countries. More generally, and then kind of more specifically, what have we learned? Well, we know, and we know this before looking at the Irish case, which is that you need to tailor. one size does not fit all. Transposing tax systems and property tax systems, probably in particular, doesn't work, we think, from evidence, international evidence. So we need to tailor it. And certainly Ireland has tailored it. Now, of course, the big issue is whether these characteristics, the self-assessment and the valuation bands, are these transitional? And that would suggest that they're going to be changed in the future. Now, we all know the adage that there's nothing more permanent than something temporary. And they may last for a long time, because if you look at the experience in England, Scotland and Wales, the valuations have not been updated since the 1st of April 1991, and the bans have lasted for those, whatever it is, 30 plus years. I said this at the start, which is this disconnect, and my last slide will re-emphasize and refocus this disconnect, in this case, between theory and practice. It's always a balancing act. There's always trade-offs involved. And certainly clearly there was here, the balancing act between, on the one hand, I suppose, speed and simplicity, and on the other hand, kind of accuracy and maybe more fairness. And that was a balancing act that had to be achieved. And of course, we all know the saying, tax administration is tax policy. And in this case, the report I talked about, the 2013 report, there was 18 recommendations, 6 of them related to tax administration. So 1/3. In relation to kind of the specific lessons, the importance of regular revaluations, and this is the thorny issue. In the Irish case, certainly the importance of filing online. So I don't know what it's like here. In 2013, in our first revaluation, the first valuation, 77% of the returns were online. In 2021, 94% of the returns are online. Now, and that, I mean, if you even compare it to the UK, they're pretty good numbers. Now, we may not be in Estonia when it comes to e-commerce, but revenue like to think that they're up there with some of the best in terms of online engagement with taxpayers. And in terms of compliance, in terms of carrot versus stick, yeah, sanctions, but reasonable, sensible sanctions as opposed to the big stick. So I want to finish with a quotation, and the quotation is a colleague of mine. If I can find it, who, when he was describing the LPT, I know what I have here someplace, described it as lacking in intellectual purity, but was a process that resulted in a workable solution. And I think if Richard Bird was here, who talked all the time about practical solutions and workable solutions, I think he'd agree with that, the focus on what works as opposed to what might work in theory. Anyway, that's the local property tax. Sorry.
Well, I would call that everything you wanted to know about the Irish property tax, but we're afraid to ask. That was a fantastic run through not only the context in Ireland, which was really appreciated, but also, what happened and why it happened and what the lessons are from it. As I sit here in Ontario, I laugh at what you said at the beginning. We studied it for 30 years and then implemented it all in 12 months. That sounded very familiar as we started studying property tax reform in 1967, as you mentioned, with the Smith Committee report, and studied it through many other reports over the years, and then quickly implemented it in 1998. And I like the way you ended by saying it's nice to be intellectually pure, but we have to be practical, and that is certainly what Richard Bird talked about. And in a paper I wrote for a conference in his honor, I talked about property taxes in the real world. So again, talking about the difference between theory and practice. there are a lot of differences between the property tax in Ireland and the property tax here, or you called them unique features, or I can't remember the word you used, but one is self-assessment, which is a really interesting concept where you don't have time or resources as a government to go out and value properties. So people know what their properties are worth, and you kind of get them to figure it out on their own. The deduction at source is really interesting because I talked about the visibility at the beginning. And by deducting it at source, you reduce that visibility. And from one perspective, that's good because people don't complain so much because they don't realize how much it is. But from an accountability perspective, that visibility is important, and you don't want to lose it. People should know what they're paying. They certainly know what services they're getting from local governments. The question is, what are they paying for them? And then the whole banding thing from the UK, which I'm not a big fan of. It doesn't sound like you are either. But those are unique features of the Irish system that we don't see in a lot of other places. But one of the things you alluded to, and you skipped over the slide, I think because you knew I was going to ask you about it, was this whole notion of reassessment. So in Ontario, under our property tax system, the legislation says we're supposed to reassess the government, the Municipal Property Assessment Corporation is supposed to reassess properties every 4 years. And then the pandemic hit. And the government said, ooh, we want stability and predictability. We're going to delay the assessment. And then they delayed it again. And that's a problem. You've also faced a problem with deferring reassessment several times since you brought in this tax in 2013. Why did they defer them in your context? And what was the impact? I mean, presumably there are winners and losers from deferring a property tax reassessment. Can you tell us a bit about it?
Yeah, I don't know if this moves or not. Anyway, yeah.
Oh, it may not any longer. Okay,
so yeah, so reassessment, revaluation, it's always a thorny issue because it becomes out of date if you don't revalue or reassess, and then it leads to inequities in terms of the tax burden. And I know it's been an issue here, although not necessarily in British Columbia or elsewhere, where they can assess once a year. So yeah, when Ireland introduced it in 2013, the promise was that they would revalue every 3 years. Of course, what we didn't know at the time was that property prices were at their trough, just in and around the time that we valued. So we valued on the 1st of May, 2013, and property prices hit the trough early part of 2013, and then they started to rise across the board, rise nationwide. And therefore, it's going to be very difficult for a government during a period of austerity to say, well, we're going to revalue, property prices are going to go up and you're going to have to pay more for the same amount of services. So what do? You set up a working group to look at it, and they did, and they looked at a number of options, but the government took a decision. And of course, remember, there was also a general election in 2016, the same time that the revaluation was going to take place. So it was deferred in 2016 and deferred again in 2019, 20. And then you would think, oh, okay, we're in the situation in England where it hasn't been revalued since 1991. And of course, the longer you leave it, then politically it gets more difficult to do, particularly if property prices are continuing to rise. So lo and behold, now maybe it was, okay, we're in a pandemic and we have to look after all the issues related to COVID and we can kind of sneak this through. So it was announced in the summer of last year that they were going to revalue on the 1st of November, 2021. Now, so it's taken place. The fact that it's taken place, even though it wasn't ideal, as I think, the fact that there's now a precedent that a revaluation has taken place is a good thing. Also, that it brought in a number of properties that were outside the tax net, those that weren't in existence in 2013. In a sense, the subsidy was being paid to those property owners. Over 100,000 properties were brought into the tax net, we think, on the 1st of November last year. So, yeah, of course, there's difficulties with this. There's winners and losers because before the revaluation took place, obviously local governments were probably the big losers because they were there was income forgone that they weren't getting. And then in terms of property owners, well, all property owners would have seen an increase in property. So they were going to be hit with a revaluation. So how does the government make this more palatable? Well, what do you expect? A widening of the bands and a reduction in the rate. So between 2013 and 2020, property prices went up nationwide on average by 74%. What did they do? Widen the bands by 75%. And reduce the rate from an internationally low rate of 0.18% to 0.1029%. So there was a promise by government that the majority of taxpayers would not see an increase in tax liability. It was estimated about 53% would see no change, about a third would see an increase of one band, so that's about €100. 10% would see a reduction of about €100, and about 3% would see an increase of more than one band. But the fact that it's happened at all, even though it's not optimal, I think is a good thing. Looking elsewhere, not only, I think Germany also had a problem with revaluing over years. I think it ended up in the Constitutional Court.
It did, yes, and now they have to do market value assessment for 2025. It's a little different here in the sense that reassessments are meant to be revenue neutral. So if we do a reassessment and property values go up 25%, is expected that the tax rate will come down 25%. So we don't have that issue of everybody's values going up, everybody's taxes going up. What happens, however, is those whose values have gone up more than the average increase pay more, and those that go up less than the average increase pay less. So some homeowners will do better and some will do worse. And that's the political issue, but also making taxpayers understand, and this is a big education thing, that just because values go up doesn't mean your taxes go up. And that's always an issue. We will take questions from the floor here if anyone has a question, and we will turn to some online questions in a moment. Let me just ask another question. You talked a bit about the government promising to do a tax on land only. So not tax on land and buildings, but land only. And then they didn't do it. Now, this is another case where economists and others disagree. Economists love a tax on land. It's the most efficient tax. It's the least distorting tax. People won't be affected about how they're going to develop their property. I mean, we go back to Henry George talked about the land tax in 1879. Economists before that were talking about it. And I've been reading articles very recently, like in 2021, 22, saying we should replace the property tax with a tax on land. And even one article that said we should replace personal and corporate income taxes with a tax on land. So what do you think about that? Is that a good idea? Why do economists like it so much? But is it actually practical to implement something like that?
Yeah, when I'm asked this question, I always remind the audience that so the economy of 1879 is very different to the economy of 2022. So, please, but on the other hand, I would say, yes, in theory, it is a good tax for reasons that Edith gave. But if we look at, so tax brings in revenue. That's the purpose of the tax. And it's also supposed to kind of distort economic activity the least amount possible. And there's been a lot of work done on this. So if you compare property tax to income tax, whether it's personal or corporate, or even sales tax, consumption taxes, there is a lot of evidence to say that property taxes do distort economic activity the least. And in terms of the local property tax, there's a good link there between the taxes you pay and the services you get in terms of allocation of resources and efficiency. So all great. However, and it's a big however, it's a big but, which is when you actually look at its implementation, there's a number of issues. One is actually trying to value land itself. In some countries where there may be the absence of a market for land, or even if there is a market for land, are we going to be able to do it accurately? Are we going to be able to do it in such a way that the taxpayer will accept it? Taxpayers don't even accept sometimes the assessed value on land and buildings, which is kind of more understandable, Are they going to assess a figure on land itself, which is always kind of a much more difficult one, I think, to understand and accept? And then, of course, that on top of the fact that you're going to have a smaller tax base. So if you want to bring in the same revenue, you're going to have to charge a higher tax rate. Now, how much of that is acceptable to the taxpayer, I don't know. And if you look around the world, despite all the academic articles written in favor of land tax, and I think the moment I'm reading Richard Barker's book on Ken Galbraith, but one of the other great Canadian economists, William Vickery, described property taxes as the worst and the best type of taxes you have. The best type of tax is because it is a tax on land or value, but the worst type of tax is because it's a tax on improved real estate. So I think that, yeah, in theory, yeah, it's a great idea, but if you look around the world, very few countries have actually introduced a classic example of a land tax where you replace everything. Because this is the notion, if you take it to its extreme, you replace income tax, personal income tax, corporate tax with a land value tax. Now, don't get me wrong, I think we need something radical, because for the last, say, 15 years, post-2008 crisis, post-2020 crisis, the housing markets, I think the huge increase in intergenerational inequities, I think there's a need for some radical changes in terms of how we manage the economy and how we look at taxes. But to me, this is not one.
Okay.
In practice.
In practice, right. Any questions from the audience? I know we have a couple of questions online, and Piali Roy is our administrative and communications assistant at IMFG, and she's been monitoring the Q&A. So if you wouldn't mind, I think there's a question on self-assessment there.
Yes, so the first question is, if revenue doesn't actually perform property assessments, how does it arrive at the guideline assessments made available at the neighborhood level through the mapping tool? And also, how could it define bands before knowing the distribution of assessments?
Yeah, no, it's two really good questions. Take the second one first of all. As I alluded to, it's arbitrary. I mean, you can look at what is in existence elsewhere, but unfortunately, elsewhere markets are going to be different. It only exists that I know of in England, Scotland, Wales, and those bands, those values were the 1st of April 1991, and the bands are there's fewer bands, and the bands they're not uniform. So what the Irish authorities did was, there's an argument for more bands, and there's an argument for a uniform interval, and that's what they opted for. Now, there may be a need to revisit these bands over time. So, I mean, the UK are looking at possibly increasing the number of bands, or there's some pressure maybe to look at the bands that were in place way back over 30 years ago. In terms of self-assessment, I mean, it's a really good question, because they don't know what the valuation is. So when you look at how they came up with this, it's based on the model. So the model does have a number of characteristics that you would expect of any valuation band. They employed your typical methodology, your CAMA, your mass appraisal values, and used a regression analysis. The characteristics that they use were as you'd expect. Characteristics such as the location of the property and others at a specific level, but they didn't have the properties that you might expect in terms of the number of rooms or the size, because that wasn't available at the specific property level. So there's a valuation model that produces what is provided to the taxpayer in terms of information. So they have actual property sales, I think they had about 30,000. Then they use the model to get to the 1.8 million of estimates. And then they go from there to these areas that are defined in legislation. So initially in 2013, they used what we call electoral divisions, which is anything from maybe 500 to 1,000 properties. And from that, they estimate a valuation band. Since then, we've got smaller areas. An area would be now about 50 to 100 properties. And based on the model, you have this indicative average valuation band. But it is a problem, because when I zone in on my estate, I've got one valuation band, but within that estate, there are 2-bedroom houses, 3-bedroom houses, 4-bedroom houses, 5-bedroom houses, and of course, all of different value. So at the end of the day, it is up to the property owner to decide. That's guidance. The revenue estimate is guidance, but I've got to take into account what the value of this property is, and I've got to take into account characteristics of this which may be different. But compared to maybe some cities, the properties are quite homogeneous at the same time. So it's not unsurmountable, but it is a difficulty. Whether they'll stay with self-assessment, I do not know, because once they've decided to go down this route, if they change, given that their database doesn't include much, it would almost like be to start all over again. And I suspect that won't happen, but I don't know.
Interesting. Zach has a question, and then John, would you mind coming up to the mic so people online can also hear you?
Yeah, I think you skipped over it just there, my question, but I mean, one piece of information that of course they do have are resale values, because they collect information from stamp duty, or what we call land transfer tax, right? So I guess it depends how many sales there are and where those sales are that enables that to feed into the model. So you said there's only 30,000 sales, a pretty small amount of turnover was able to be incorporated into it. I guess to jump to a second question would be, I mean, do you have rental apartment buildings? Are those treated as a commercial use, or are they part of the residential property tax base, and how are they valued? How does that fit in? Do you have condominiums in Dublin and that kind of thing, that or is this really just about houses, detached freehold properties that are owner occupied?
Yeah, so Dublin is not like Toronto, and outside Dublin certainly isn't like Toronto or outside Toronto. We don't have condominiums. A very large percentage of properties are kind of the traditional properties that you see in the UK or Ireland. Owner occupied. Of course, we have a rental market, but the owner is the person that's liable. It's the owner that must come up with the estimated value. When I said 30,000, of course, there's many more sales, and have been since this has been tracked through, but that's what they used in their valuation model. But these could be sales from previous years, and given the property prices have gone up, those sales are now dated. And of course, there's many properties in the residential market that haven't been sold. And so the question is, how do you value them? And you can go to, as I said, you can go to a professional auctioneer, you can rely on the register, but at the end of the day, it is a judgment call that the property owner has to make. And what revenue are trying to do is trying to provide as much information as possible. But of course, there are going to be valuations, undervaluations. The question is, how serious are the undervaluations? Because it could bring in much more revenue than the limited revenue it does bring in.
John, and then we'll go to the online questions.
Yeah, thanks. In a sense, you just began to touch on a question I have, which is, and in a sense, I'm very pleased to hear the self-assessment approach works, because I have, looking at this when I worked way back when we started to introduce this in 1970, the notion of self-assessment is actually quite appealing. And it really, in a sense, is sort of a demonstration of a belief in the honesty of the citizenry. And I think that that's, in a sense, a very encouraging aspect of approaching it in that way. But on the other hand, just as one thinks of the income tax system, the notion of keeping everybody honest through the use of an audit seems to me a very important aspect of a system of this nature. It has to be, implemented in a delicate way. And I wondered, whether in fact that was the thought, because it seems to me that if you sort of say, well, we'll trust you to come up with the idea, but we do have a certain percentage of people whose assessments will be reviewed and so on and so forth. And the other point, which actually is to do with when you've done the self-assessment, in a sense, if you've created the assessment role as we do here, and then municipality then says, well, we need to collect a certain amount of money, which then sets the tax rate based on that tax roll. And I wonder whether there's any thought in the sense of saying, now we know how much everybody thinks they're worth, and we're comfortable with that. Now we're going to set the tax rate based on what we need, and people can argue about whether or not we need too much money or not. So there's two aspects of the question.
Yeah, the tax rate. So I often get asked this question about where the tax rate comes from. There is a local adjustment factor, so local authorities can vary the central rate every year by a certain amount. So there's a band, there's a lower band and a higher band. The rate itself, so my understanding is that they set a target of as it happens in euros, of 500 million to bring in. They had an estimate of what the exemptions and deferrals and maybe what the undervaluations might be, worked backwards, and on that basis they came up with a basic rate, a very low basic rate of 0.18%, which by international standards is quite low. I think Bulgaria, there's a few countries that have that kind of a rate, but it is quite low. The auditing, yeah, I mean, I can't see the data on that, but they do audit. Revenue has the power to challenge. You can self-correct. Revenue can inspect a property. But I think, as I've said, they would prefer if an honest and reasonable attempt was made. And this is where the revaluations come in, which is there was a revaluation, as I said, last year. And initially it looked like that the numbers were going to be okay in terms of how much this was going to bring in. It was going to bring in a little bit more than what it was bringing in at national level. I was talking to a chief executive, we call them chief executives, managers of local.
City manager.
Yeah, local this morning. And they're a little bit worried about the numbers in that the compliance rate is a little lower than what it was prior to this. Now, one mightn't be all that surprised given that we've come through 2 or 3 very tough years. Some local authorities, the one I'm looking at in particular, it's a rural local authority, so it doesn't take in a huge amount from the property tax. But given the design of the Irish property tax, which is that some of the revenue is used to fund an equalisation grant, if the total amount is less, that means the percentage that is pooled is less, which means they may even get less next year than what they were getting in the last number of years. So with a revaluation, even with all the amount of auditing and inspection and sanctions that are going on, I still think, self-assessment can be a risky one to go with property. And we don't know where this will end. I suspect that we're stuck with self-assessment for some time. The difficulty will be that as you have more and more revaluations, will we see more and more undervaluations? And if that's the case, then revenue may have to make a call on it to move towards a more conventional agency, which is there to assess it and put the resources and time involved into it.
Okay, over to our online questions.
I have a question from a municipal auditor, and she's asking, have there been any studies on the proportion of residents that are honest in their self-assessment?
Not that I'm aware of. Revenue's focus, I suspect, for the last number of years was the revaluation, to get it done and over with. And even, the data that, I alluded to this earlier, the data that revenue provides in terms of what they call undervaluations are not really undervaluations. That's just the technical difference between the revenue estimate and what I returned in terms of the valuation band. So to do a serious bit of analysis on this, you'd have to take what the market says your property is worth in terms of real estate. Then you'd have to look at what you returned in terms of valuation. It is not public information. So only I and revenue know this information. So there's issues with how you would go about trying to figure out what is the degree, the real undervaluation that's going on. There is certainly some, but to be fair, there were also overvaluations. There was a large number of returns which were in excess of the revenue estimate. So just like what John said, some of us are trying to be honest, some of us think our properties are actually more than what revenue think, and we return that. Now, how much, actually I was surprised to see how much overvaluations there were. I wasn't surprised to see how many undervaluations, but there are overvaluations, and quite a number.
So this would mean there's no appeal system.
Well, I was going to say there is,
Okay.
but that's in relation to the non-residential side. On the residential side, appeals, I mean, think about what's happening here. The revenue's flipping it, and the government is flipping it, which is normally what happens is the government or an assessor will assess your property and then they'll wait for you to appeal it. That's not happening here because you're appealing it and then you're waiting for revenue to come after you if necessary. So no, there's no appeal.
Yes. Graham Sansom.
Thanks, Enid. Thanks, Jared. One of the other underlying issues with local property taxes, it seems to me, is always how they're perceived by the people paying them. Are they perceived as a tax? You've called this a local property tax unequivocally, but to what extent are people seeing it rather as a fee for services, particularly given that, as you just said a minute ago, and I'd be interested to know to what extent this is happening, that local authorities have discretion to vary it up or down a bit. The other thing that links to that you've touched on, and maybe you could say a little bit more about, is how this feeds into the broader local government funding model. Because it seems to me that there's a danger here, maybe it's not a danger, that the local government funding model becomes highly centralised. These taxation flows go into central government, which then, as you say, uses some of them for equalisation purposes and therefore has a fairly big say in where the money eventually winds up, local authority by local authority. And the other little thing that I'd be really interested to know is what you regard, or what is being regarded as a sensible sanction.
We're going to make this the last question because it's 6 o'clock.
Okay, yeah, a sensible sanction. Let me start with the last one. What's a sensible or realistic sanction? Well, I can tell you what a non-sensible sanction is, or a draconian sanction, which would be, and this is again in the theory, people would say, okay, if you're going to self-assess, one thing you could do is you could force the state or revenue to say, well, we can buy your property at whatever you assess it at. Now, I don't know how sensible that is. That might go too far. Or you could be imprisoned for non-payment of 350 euros. I think that's not very sensible or realistic. So a sensible sanction, I think, is penalties and interest, and what they've decided, a charge on your property, which is normal, I think, around the world in many countries. So I think they're sensible. The funding model, where to start and where to finish, in that reviews of funding models never end. And at the moment, there is a kind of an informal review of the funding model, if there's such a thing, particularly in relation to property tax, the local property tax, the burden that's falling on non-residential. So yeah, it's not perfect, but I do think it's better than what it was, which is no tax on residential properties. It's certainly not perfect in terms of how much it brings in. It's certainly not perfect in terms of the balance between charges and fees and taxes and grants. And I think at the moment we're looking at equalisation grant again. If there is a real problem with the funding model in Ireland, I think it's not the tax and it's not the charges. It's the equalisation model that's part of the grant system. That's where I think more work needs to be done, because there seems to be huge inequities in terms of which local authorities receive grants and on what basis. And on your first question about is the tax or is it a charge, as viewers, as taxpayers perceive it, I'm sure many taxpayers don't distinguish the difference between a tax and a charge. They see it as a burden out of their disposable income. We distinguish between taxes and charges all along, but I suspect, I know many of them don't. There's been no work done on this. We're not very good in Ireland at asking taxpayers or citizens at the local level how they feel. I would prefer, we talked about this in terms of a kind of barometer. We're trying to start, I know there's one that happens here and,
Yes.
and it happens elsewhere. We've started to look at these barometers where we ask the citizens, how do you feel about public services? I suppose in the past, we probably didn't need to ask them about local public services because there were so few of them in the first place, and they weren't on the hook for them in the second place. And we didn't have to ask the politicians, and we didn't have to ask the payers, because the taxes were being paid by somebody else. I'm sure we all love that. And services delivered by local services were very, very, very few and far between.
Well, I know I could go on a little bit longer, but we're supposed to end at 6, and so we are going to have to end at 6 or close to it. There are more questions online, I know, and we will provide them to you, Jer, so that you can see who asked you questions and maybe answer them offline. Also, the event has been recorded and will be available on our website in the weeks to come, so pass it on to others who weren't here. Thank you, Jer. That was a great presentation. I think everybody now understands how the property tax works in Ireland and what the pitfalls are and what the good points are. So thank you very much for doing that. Jer is writing a paper for IMFG on the property tax in Ireland. And so in the coming months that will be produced, and anything you missed today you can read in that paper. So thanks to you, thanks to our online audience, thanks to the people here in the room. Have a great evening.
Thank you.